Don't invest in dividend stocks unless you understand these two things. Hi everyone, and welcome back to another long form video. I haven't posted a long form video like this in a few weeks. I've been focusing on shorts and reels, which YouTube seems to be updating and pushing, but I'm going to try to go back to a few more long form videos. I'm going to be telling you the downsides of dividend stocks, and then next week I'm going to recommend dividend stocks. So this video is not saying never invest in dividend stocks. I am saying these are the downsides, and then next week, I'll tell you what to invest in as long as you keep these two things in mind. Before you get started, if you're interested in beginner Canadian finance advice, I made a little ebook for you. Just sign up with your email, and then with your email, I'm going to advertise my course. My course just teaches you about budgeting, credit, finance, taxes, and how to invest. Just sign up with your email if you're interested. Now let's get right into it. So I don't really have a script for this video. I'm just gonna talk off the top of my head. I'm going to be reading off my laptop while I pull out charts. I'm just gonna put a snippet just in front of my face because I'll be looking down and it's not very, it just doesn't look very good in a video. So here goes. The downsides of investing in dividend stocks are you don't get a lot of growth compared to growth stocks in your portfolio, and there's the danger of your dividends being cut as we enter a recession. A few years ago, a bunch of REITs have cut their dividend, and now we're getting either dividend pauses, so it's not increasing, or some people are cutting or eliminating dividends. But I'm gonna briefly go through let's say I'll do 10 stocks. I'll do the year-to-date performance, I'll do 1 year, and then I'll do 5 years. What I'm comparing to is the S&P 500, the largest 500 companies in the US. This is what everyone should be investing in. I'm gonna compare everyone's performance and just talk through some of the numbers. Starting with TELUS. Look at year to date, it is down 15%. If we look at 1 year, it is down 21%. If we look at 5 years, it's down 3.77%. So a lot of ups and downs with TELUS. Over these 5 years, you'd be earning 6.56%, which is fine. You're earning the dividend, I get it, but your portfolio isn't growing. I'll make a recommendation at the end of this video of what to do. If we move on to Bell Canada, year to date, down 13.9, 1 year down 13.6, 5 years, it is break even. It is basically up 1 penny, 0.02%. Over this time, you'd be earning 7.46%. While you are earning dividends, it's great. You're not getting any portfolio growth. If we move on to some US stocks, year to date, Realty Income is down 21%, which is huge. 1 year, it's down 15%. 5 years, it's down 9.63, all the while earning 6%. Rogers Communications, year to date, down 18.5. 1 year, down 4%, not bad. 5 years, down 21%. So over 5 years, you'd be earning, let's say 3.84. Let's say you'd be making 16, 17% in dividends, but then you're down 21%. You're pretty much losing money over 5 years. Suncor, they're actually up 13%, which is interesting. 1 year, they're up 11%. 5 years, they're down 7.83. So a little bit different here because Suncor is an oil stock, an energy stock, and the oil seems to be doing pretty well in 2023. Let's go on to banks. CIBC year to date down 5.3% because they have an overexposure to mortgages. 1 year down 14.8%. 5 year down 12.99. Let's just call it 13. All the while earning 6.64. Let's move to Enbridge. Year to date down 15.5%. 1 year down 14. 5 years up 3.21%. Okay, I wasn't expecting this. Over 5 years, you'd be up 3%, which is great, all the while earning 7.88. Let's go on to Smart Centers, Smart REIT. Year to date down 16%. 1 year down 13.6. Sorry, I'm dyslexic. 5 years down 27%. Let's go back to some US stocks. A big one, Johnson & Johnson, down 12.5%. 1 year down 4.56. 5 year, it's actually up 12%. So you're up 12% all the while earning 3% per year. Not bad. but it could be better. Let's go on to Coca-Cola. Year to date, down 11%. 1 year, down 1%. 5 year, up 22%. This is actually pretty good. This is a good example. So I'm going to give you all these numbers, but you're like, hey, they're all down or up. What's the point? What am I comparing to? I'm comparing to SPY, the S&P 500. If we look at year to date, it is up 12%. So no other stock I showed you, I guess, except Suncor is up. 1 year, it is up 16%. And 5 years, it's up 48.5%. So you see the difference. This is up year to date, 1 year, and 5 year. Dividend stocks underperform to growth stocks. I'm not saying never invest in dividend stocks. I will be recommending stocks to invest in next week, dividend stocks to invest in next week. My recommendation is you understand that your portfolio won't grow as much. My recommendation, invest in growth stocks until you retire and you need the money. So invest in the S&P 500. You'll get these growths. So over 5 years, you would have been up 48%. You could take that 48 and invest in dividend paying stocks when you retire to get that monthly yield or quarterly yield if you want. You get that income. What people recommend is that you invest in the S&P 500 and you sell 4% or 5% of your portfolio every year and you'll do better off overall. I don't like the idea of selling my portfolio. It might do better overall, but mentally I wouldn't feel right. When I'm retired, mentally, I think I would feel better, more relaxed if I got consistent dividend paying stocks. So I would recommend investing in companies that increase their dividend every year and don't have a history of cutting or pausing. My second example, when I said there's two downsides, I believe First Capital cut their dividend by 50% a few years ago. RioCan cut their dividend by 30%. Northwest REIT just cut their dividend by 55% a few days ago or a few weeks ago. Suncor cut their dividend by 50%, and then I believe they reinstated it, which caused the stock to go up. Just be aware that just because it pays dividends, it's not guaranteed, and sometimes it's not stable. Some people might pause. A pause in dividend is not the worst thing in the world, but when you think of inflation right now at 7 or 8%, a pause indirectly means you're not getting a pay raise, you're losing money, you're losing buying power. So just be aware of the ups and downs and the shortfalls of dividend paying stocks. It's not the be all end all. I think I'm going to end it here. Thanks for watching and tune into the next one.